Hello traders, my name is Jody Samuels and welcome to the Global Market Analysis for June 10th, 2016 for the upcoming week. It was a quiet week in the financial markets as investors are sitting tight waiting for the next FOMC meeting held later this month. After a strong rally to start the week, the S&P 500 gave back all its gains to settle the week flat and closing near the critical 2100 level. Similarly, crude oil prices also managed to trade almost $2 higher from the open on Monday, but also reversed its gains from its weekly high of 51.67 all the way back to below $50. The U.S. dollar, on the other hand, made a strong late-inning comeback, with gold surging almost $28 an ounce for the week and 10-year Treasury yields finishing the week down 6 basis points to 1.66%. All eyes were once again set on Janet Yellen, who publicly spoke for the final time before the much-anticipated June FOMC meeting. Remarks made by Yellen on Monday were unsurprisingly dovish as the Fed assured their patience to hike rates. As a result, the U.S. dollar weakened for most of the week, with the euro reaching a 3-week high of 114.15 before trading lower. The markets are now pricing in a 0% chance of the Fed increasing rates at the June 15th meeting, while the odds of a December year-end hike has been trimmed 15% from last week to 59%. Yellen stated that last week's horrendous jobs report was in fact concerning and will continue to watch the labor market closely to gauge the overall health of the economy. This chart shows how well the euro, oil, S&P, and gold continues to correlate since January of 2016. And as we've discussed before, intermarket analysis is key to understanding what is driving markets at any point in time. And there are certainly different drivers. Currently, the key drivers are U.S. economic activity and when the Fed will raise rates. If you look at the chart, gold and the dollar followed their inverse relationship for the most part as the dollar sold off to start the week and gold rallied. However, they diverged on Thursday and Friday. Also, the S&P 500 followed the movement of oil this entire week. Moving over to Europe, a potential Brexit continues to put investors on cautious mode as polls throughout the week showed more citizens were in favor of leaving the EU. The low volatile environment is signaling that investors are sitting on the sidelines waiting for the June 23rd referendum to give a clear mandate on global risk. However, Draghi noted that more stimulus would be required if a financial shock from Brexit were to take place, causing the euro to sell off Thursday morning. This is the move down on that. On the other hand, the European Central Bank commenced its corporate bond buying program on Wednesday to bring inflation and growth back in the euro area. The euro USD has already corrected the last swing move higher by 50%. In other words, we can only see 5 days of price action here, but imagine that the euro has come up. And now this move down is a 50% correction of the last swing move. So expect at least a test of the 61.8% at 112.43, not to exceed 111.40, which is where this swing move started. Went from 111.40 up to these price highs at 114.16. And currently we've retraced 50% of that move. A breakdown of 111.40 will imply lower levels. Otherwise, expect the euro to test lower, and if it holds that price, expect it to trade back up to the highs witnessed this week. And this is where the divergence started also in gold, as we will see when we look at the gold chart, where gold continued its move higher and the euro diverged down. Moving on to crude oil, it finally pushed well ahead of the highly watched $50 level and traded as high as 51.67, which was a 9-month high. But it gave back all the gains to trade at 49.85 heading into Friday. Initially, continued worries of a supply shortage out of Africa's largest producer in Nigeria aided prices higher. Thereafter, oil soared higher after Wednesday's EIA report showing crude inventory declined by 3.23 million barrels last week, meeting analysts' expectations. Moreover, the EIA forecasts that crude production out of U.S. will continue to drop in 2016 and 17, as well as an uptick in demand for oil this year. Hence, the positive sentiment within the energy markets, combined with a weaker U.S. dollar from expectations of a postponed rate hike, has given an extra boost for oil prices lately. In terms of next week's price action, expect oil to consolidate its gains. On the top side, watching the 51.67 level, the high, and on the downside, watch last week's low at 47.75. And expect the market to fade the moves higher, and if we breach and make a new high, don't get overly excited about buying it at those high levels. On to gold with the Euro USD overlaid over gold. Gold prices sustained its rally after last Friday's disastrous non-farm payroll report, soared $35 to close the week at a 3-week high. As you can see, the usual correlation weakened slightly on Thursday, which saw the US dollar strengthen. As the euro goes down, the dollar is strengthening with an increase in gold prices. From an Elliott wave perspective, on gold, we completed 5 waves up on gold this week. So expect a retracement of the move into this week, into next week. If price continues above the highs of 12.78, these highs, a potential extended trend move will take place. So watch this area very carefully. Finally, the S&P with oil as the overlay. The S&P was on its way to testing the all-time highs before coming back all the way down to test the significant 2100 level. The markets reacted positively following comments from Janet Yellen and continued to trade alongside the direction of crude oil as prices reached an 11-month high at 21.20. Investors appeared to have brushed off last week's horrible job numbers given the dovish tone of the Fed. For this week's price action, expect the S&P 500 to potentially retrace the last swing move up from 2025 to a high of 21.21 by at least 38.2% to 2084. So that's the minimum retracement. And the 50% is probably around the 2075 level. So expect that retracement. Have a great trading week, and please, thank you. And if you enjoyed this video, please like and subscribe. Thank you very much.